maybe you don't want to look at inflation, but you want to look at credit creation as a key metric, and you worry that it's slowing. That doesn't seem to be the view of Fed officials, at least not as expressed in the minutes, where they say that credit creation for households seem to be moving right along, and that overall financial conditions for non-financial firms were, in their words, improving a bit. How do you square what you see with what Fed officials seem to be seeing?
Well, Fed officials can pounce on whatever good number they like. Actually, in terms of total credit, which is $62 trillion, there's the household sector, business sector, finance, government, all in combination. The household sector includes credit cards as well as mortgages, and combined, the private household sector has not been creating credit at a pace greater than 2 or 3%. Yes, credit cards have been growing at 6, 7, or 8%, but when you combine it with mortgage creation, it's a very low number, and certainly not enough from the household sector and not enough from the government sector to produce credit growth that's necessary for even a subpar economy such as we have in the United States.
Corporate credit does seem to be rallying around the world. A lot of investors may be using it as a proxy for sovereign these days. Do you think that's wise, or are people just fooling themselves about credit quality?
Well, to some extent, I think all prices are artificially high. We observe that with sovereign credit, where interest rates, for instance, in Japan are at 0 or less all the way out to 40 years, as an example. But corporations are next. I noticed the situation today with the NEIC, which is the insurance regulator for the United States, and they're suggesting downgrading regulations for corporate credit, allowing insurance companies to buy high-yield bonds at half of the regulatory penalty that they had before. I worry about those types of things, because spreads, yes, on high-yield bonds are 400 to 500 basis points, and on investment-grade corporations are 75 to 80, but they're relatively low compared to historical examples. And certainly, if we get into a slowdown or even a recession down the road, there's problems there with those narrow spreads. I wouldn't buy them.
Well, you got record low yields today in Australia, in Japan, in the UK, in Germany. The U.S. 10-year note yield falling significantly. Are you still willing to buy sovereigns, or is it at this point too risky?
Yeah, I think it's too risky. Germany all the way out to 20 years is negative. France is in the negative category. The UK is inclined to move close to 0. Japan, as I mentioned, all the way out to 40 years is at 0. I mean, these are examples that would have been unheard of, or you must be joking type of examples 4 or 5 years ago. So, it's obvious that an investor can't be concerned about the return on his money, with sovereign bonds, because there is no return. He or she should be concerned about the return of their money, because at high durations, which we have now at low interest rates, even a small change in terms of yield can produce a significant loss. So the sovereign bonds are not up my alley.